Where do Social Security funds come from? Employers, and self-employed pay Social Security taxes known as FICA. The employee and the employer each pay 7.65% of income to a cap that's indexed for all Social Security benefits except for Medicare. There is no cap on the Medicare payments, so Bill Gates or someone of his wealth who earns very large salaries will be paying Medicare on the entire salary. Medicare portion, as I mentioned, has no cap. Self-employed pays both the employee and the employer's shares. Covered employee is one who falls under the Social Security umbrella of payments and benefits after contributing for approximately 10 years, the 40 quarters we talked about in Module 1. Benefits also based on the contributions. These are also referred to as fully insured workers for purposes of Social Security. How do we calculate it? Determination of benefits requires specific detailed information regarding age, earning history, retirement date. I might know when you file for Social Security, there's a form you have to fill out. It can be done online or it can be done in the office of Social Security. It requires a lot of questions. I remember the questions they asked me were about my military career, which was 40 years earlier, but I had to get the information about any marriages, etc., that you've had. So it's a very extensive form you have to fill out for purposes of retirement that people don't realize ahead of time, and then you have to pull out data together. So I always tell people, get a copy of the form on the internet or at the Social Security office near you. Spend a month getting the information together, a plan that'll take a month, so that you're able to get it in on time. The average index monthly earnings is a calculation of the earnings during the 35 highest earning years of the worker to bring them up to the current dollars. Now, you have between up until 62. At 62, you cannot take advantage of higher earnings because that's the cutoff. But let's say you had your highest earnings were between 25 and 55, 60. Those are what you'd want to use, and that's what they are using. And they make an adjustment for inflation. There's a built-in formula for that. And this is done to account for changes in average wages and inflation over a lifetime. So it's pretty much inflation affected so that the numbers come out right. So that again, it's very objective. Anybody who sits down with the calculation can do it. The primary insurance amount is the result of the formula applied to the AIME earnings. The PIA is the basic benefit that determines the amount one will receive at full retirement age. The amount the worker and a dependent receives is based on the PIA of the worker's first year of eligibility or date of disability or death. So if the 62 becomes important for that aspects, even though they may not want, even though the recipient may not take Social Security till as late as 70, 62 is the first year for eligibility and based on that PIA for that year. Benefits depend on age of retirement. Generally, benefits begin at 62 at a reduced monthly basis, and they restrict the amount of money you can earn under the normal retirement age. That amount you can earn is relatively small and is indexed. If you earn more than that, you lose your Social Security in a prorated value. Delay in retirement past the full retirement age increases the monthly benefits, as the theory being everyone who gets the same total amount irrespective when they start receiving the benefits. So those who receive at 62 start getting benefits at a certain rate, which you can see in the textbook, of adjustment for each year till 67, and then also from 67 to 70 the adjustments. And if you're good at algebra, you can calculate what is the crossover year, in other words, the year that they assume the payments will be equal. And I have never done it, but I have had students who do it. Taxing the Social Security benefits, surprising to most people that they're going to get taxed on the retirement when they receive it. Earning limitations for those who retire under the full retirement age is taxed for any earnings over an index value until the year they reach the full retirement age, and I discussed that before. So you can earn a nominal amount and retire prior to 67. In the year of reaching full retirement age, which is 67 if you're born after 1960, The allowed earnings is indexed but higher than the previous years under Social Security. So in that year you turn 67, you will have more you can earn. And earnings in excess of the limitation part of Social Security benefits are reduced or eliminated, and a worker is required to file a statement of earnings with the Social Security Administration by April 15th of the following year. And that most people forget. That's one of the things of going to a CPA or an enrolled agents. They will automatically take the forms and fill them out for you so that you submit it on time by April 15th for the government to be sure that you're getting the right amount of Social Security after the adjustments. After reaching full retirement age, there's a special tax on earnings, although the Social Security may be subject to income tax. And that's the next slide. We'll talk about the income tax. But so if you turn 67 on May 22nd of the year, everything after that May 22nd, no restriction. Prior to May 22nd, you have that rule for the year of retirement. Those taxes on those who reach full retirement age, Social Security benefits are taxable for income exceeding an index, and the taxable amount is dependent on the meritable status and the following we're going to talk about. First of all, we have to take a look at what the adjusted gross income is of the client. Then we add in any interest on tax-exempt bonds, and many retirees have that, and they don't realize it's affecting how much it's going to affect their Social Security taxes. Interest on U.S. savings bond is used to pay for higher educational loans, and that's kind of rare. I never had that case, but that certainly could happen, that they're paying that interest because of the loans they probably got for grandchildren. Any deduction they've taken for qualified educational expense, any foreign income tax exclusion, and 1/2 of Social Security benefits which will be received. All of that together is used to determine what is the amount of items that will be taxed. And workers are insured for disability benefits if they're fully insured and have at least 20 quarters coverage out of the 40 before the disability. However, workers disabled before 31 need quarters equal to 1/2 the quarters that relapsed since the worker has reached 21. We mentioned that in the first week module, this week's first module, and there's a minimum of 6 quarters required, so that would be 3 years. I'm sorry, 1.5 years. Benefits may be available for members of the family if the individual is eligible for retirement or disability benefits. Survivor benefits may be available to members of a worker's family if the worker earned enough Social Security credits during lifetime. And the maximum amount the family can obtain as survivor benefits is called the maximum family benefit. In other words, there might be a spouse and 3 children and parents who are all eligible to get retirement Social Security benefits on the deceased that was supporting them. However, that benefit is going to be limited to, and it's limited to approximately 150 to 180% of the worker's PIA. And again, the PIA goes back to their when they were 62. So it's not an unlimited amount. Your textbook shows the index amounts that can be used. Again, not a lot, but it helps provide a safety condition.